of thumb for Roth IRAs. We're going to talk about contributions, conversions, and more. There's a lot of confusion that's here. And I'll break things down in just a few moments. We'll do a quick Google search, and then we'll walk through 5 rules of thumb for you that really help you understand this specific tax wrapper that can be around a handful of different types of accounts, but this specific tax wrapper, and how you can better understand how to get money into it, but then also how valuable it can be in and through retirement. Now, disclaimer, I always like to share this at the beginning of the talk. This video is only meant to be helpful hints and education. It's not specific tax, legal, or investment advice for you, so just be wise and responsible. Before considering acting on anything you might see in this video, first consult with your tax, legal, or investment advisor. So diving into the topic. So rules of thumb for Roth IRAs. And this is something in general that I plan on using as we continue to develop more content for this group and help you engage with the group. I want to kind of show you that sometimes when you Google search things, it can be tough to get the correct answer. So when I was thinking of this topic, I thought, wow, I get these questions all the time about confusion about Roth IRAs. People think that they're not eligible for them because of the stuff they read, and they're confused between contributions and conversions, and they don't understand how the tax works. How do you get money in there? Aren't there rules for contributing, they ask. Don't I have to pay taxes? And it causes all this confusion. So I wanted to go and create a list of rules of thumb because, quite frankly, I Googled it first. I thought, okay, let's just see if there's something out there. And as you'll see with anything you'll Google, especially in the retirement, investment, financial space, you have to be thoughtful about what you're looking at. So you Google it. I'll pull this up. You Google it, and you get a handful of articles. Oh, contribute as much as you can. First meet your 401k, then max out Roth, and then go back. Okay, well, that's all right. I guess it's a rule. It should max out, rule of thumb, but also what if I'm not working anymore? Here's a rule of thumb. Choose Roth over taxable if you expect to qualify for tax-free distributions of the earnings. Well, what's that mean? Looks like you might be able to dig a little bit there, but I went into that. It's a little confusing for folks. Talks about restrictions for contributing. This is contributing, not converting. And again, this is kind of an area that people get tripped up on. I know it's contributing because it's referencing this right here, but I also noticed that this is from a couple years ago. So you could click onto that and then be technically reading some information that's a couple years old. Here's this one's at least more recent from last year. This gets into the confusing Roth IRA 5-year rule, which is something that we'll probably have to dig into in a different video. 4 reasons to choose. If you think you'll be in a higher tax bracket when you retire, consider using that. That's definitely a rule of thumb. You'll see that on our list. But the reason I brought that up was that if you Google something like this, you actually have to remember to look at when the article was written. Remember, there was some 2014s, 2020s in here. And also what timeline it's talking about. You have the time period before you enter retirement where you're still working, and then you have the time period where you're in retirement where you're no longer earning a paycheck. You might not even have earnings. And there's different considerations when it comes to Roth IRAs in those 2 timelines. You have to look at when. And ultimately, you've seen me share this image before because it's a sample that I've used in the past. Seriously considering the Roth account and what it can do over the course of your retirement. Here was one example. Cutting down expected taxes that a person would pay. Not only 50 grand, not only 100 grand, but several hundred grand potentially over the course of their lifetime. It is something that you seriously have to consider. So retirement in plain English. I wanted to break down 5 rules of thumb for us. And let's just start with the first one. Bottom line, especially with what you've learned so far about tax wrappers or what we've talked about in terms of tax buckets or tax wrappers, tax diversification is incredibly valuable. We've shared kind of this wrapper image, well, at least the category image for the wrappers. I've kind of explained to you in the past, and we've talked through with folks, how this is all deferred and it's going to be taxed in the future. This is all tax-free. It's been taxed already, and it won't be taxed in the future. And the challenge that we have is that many folks have the majority of what they have the overwhelming majority, in 90+% of the cases that I see, is all wrapped up in pre-tax IRAs and pre-tax 401ks. And that just creates a problem in the future when you want to spend. Like, let's just talk bottom line about spendable money. You want to spend $12,000 on something, right? If you have a tax-free bucket or a taxable wrapper, which is like a bank account or whatnot, but let's just talk about the investment side. If you have a tax-free bucket, you want to spend 12 grand, you take out 12 grand, you're spending 12 grand, right? That's plain English. You're spending what you withdraw. When you take out 12 grand out of a pre-tax IRA or 401k, you may have to take out 15 grand, give or take, based on some of the math and what's going on in your world and how it pulls onto your tax return. You might have to take out 15 grand to spend 12 grand, right? So it's a completely different animal and it's beneficial to you. So tax diversification becomes incredibly valuable in retirement when you have different buckets to grab from in any given year, right? So bottom line, tax diversification, thinking about the rule of thumb is, how do I get money into this bucket? And then ultimately, how do I get more money into that bucket? And then gives you flexibility on what to spend it on. So rule of thumb number one is tax diversification. Not just asset diversification, not just different types of mutual funds and ETFs and things like that. Literal tax diversification on your balance sheet is an incredibly important rule of thumb that we have to be thinking of. Because you might remember from some of our previous talks, I'll kind of draw this here. When we get, remember that all the stuff that ends up on the right-hand side here kind of trickles down and becomes taxable. That becomes taxable, right? So when we don't have Roth accounts to pull from, anytime we touch our IRAs or our 401ks, money lands here and it's ultimately taxable, possibly makes other things taxable. But when we have on our balance sheet, and I'll make this blue, when we have on our balance sheet a Roth IRA and it comes out here, if we take a distribution, but it doesn't show up over here, that is incredibly important through retirement when it comes to taking a vacation, doing stuff that won't increase the taxability of other income streams that you have coming in, especially like Social Security, like we've talked about before. So tax diversification is an incredible rule of thumb. Now, rule number two, contributions are not the only way to get money into a Roth IRA. Not. So this is where I'm going to help you break down the words contribution and conversion. Right? So contribution is when you actively take money from your bank account and push it into an IRA. Or push it into a Roth IRA. That's a contribution. Right? And there's limits and rules and there's thresholds as to when you can do it and when you can't do it. Conversions are different. Conversions are when I'm looking at the language I have here. Conversions are when like we've talked in the past, when we take a chunk, drag it across the line, and now consider it tax-free. So you take a chunk, let's say you take 20 grand, right? And then over here, you plunk in 20 grand. It's rewrapped. You're ripping the wrapper of the IRA off. You're rewrapping it with the Roth account, right? You end up paying tax. You have to pay tax on that. You pay your tax. You pay Uncle Sam from your bank account ideally. You pay the tax on it, right? But now you have a Roth conversion. There are no limitations in regards to how much you can convert. There's no limitation. Now, it doesn't mean that you can just willy-nilly do it and that you should do everything. That's not the case, right? But the rule of thumb is, and this hopefully lands, 401ks and IRAs are good ways to get money in position to be converted. So this is where we get into that. You see the other rule of thumb from the Google list, like, yeah, contribute to your 401k at work and whatnot. If you're a saver, I think that's incredibly important information and a good thing to consider is push money in there. If you get a match, that's great. What's happening is you're getting money into that red bucket, sure, but you're getting money to that red bucket, and that positions that money to be able to be converted at some point in the future. It might not be this year, it might not be next year, but you're positioning it to be ready to get it over there. Because once you stop working, once you stop working, you technically can't do a contribution. Like I said, this webinar is not going to go into the details of the limits of the contributions and qualified distributions and whatnot. We know this is an incredibly important account. We know we can spend all the money and not have to pay taxes on it. When we have this on our books. But contributions are not the only way to get money in, right? So I want you to consider that as a rule of thumb, that getting the full match in a 401k, being a strong saver, pushing money into that world, is also the back end of that story is also you're positioning yourself to convert to Roth in the future. So 2 good rules of thumb there so far. Any questions? Let me know. But rule number 3, you may not, ready? You may not be in a lower tax bracket in the future. I'm probably going to have to spend a few minutes on this one here. Let me take a sip of coffee here as we're talking about this. One of the things that many people think when they're saving for retirement and they're working, they're earning money, they're deferring money into those red buckets like we've talked about in the past, the pre-tax buckets, deferring tax, not paying tax today. So one of the thought patterns of that is that, yeah, but I'll probably be in a lower tax bracket when I retire. Those folks don't always recognize that Social Security is and can be taxable. They don't always realize the math and how to pull it all together to determine what their tax bracket is. But the fact of the matter is you may not be in a lower tax bracket in the future. And that's compounded even more with the fact that technically a couple years ago, our marginal tax brackets were reduced, and a few years from now, they're actually set to go back up. So anybody that's in the 12 will bump back up to the 15 if that stays the same. Anybody in the 22 will bump back up to the 25, 24 will bump up to the 28, right? So here's a visual that shows the tax brackets for a married couple and shows the tax brackets for a single filer with the IRS. And what I wanted to do with this is just kind of marry up roughly the same amount of income, showing it on I like to call this a column. That's how marginal tax brackets work, right? Money gets poured into the column here, and as it comes up, your next dollar is hit, your first set of dollars is hit at 10%, your second set of dollars is hit at 12, third set of dollars is hit at 22, then you bump up into the 24 bracket and the 32 bracket, 35, 37 goes up above that. Single filers, you notice, they hit those thresholds a little sooner, right? So the 10% ends sooner, the 12% ends sooner, the 22 starts sooner, 24 starts sooner, right? But the concept is, and this is how this became a rule of thumb, many people don't realize that they may be in the same tax bracket in the future, whether it's immediately in retirement or when required distributions start. So let's kind of just kick that around. I'll use this kind of timeline. I like to kind of draw this out so folks understand it. And we're just going to use a married couple, right? So talking about a married filing joint, married couple. The timeline would be, let's go 62, 65. I want to do about the same scale, 70, and then there's 72. And there's a reason why I'm doing that over here. So let's just pretend that when a person stops working, right? Let's just pretend, well, actually, let's start with working. Let's just say when a person is working, let's say that they're bringing about 150 taxable into the house. I'll make this green. I'll make it green. Let me make that green. Yeah, so let's just say, so using the scale over here, let's just say that bringing about 150 into the house, right? Taxable. So they're technically in the 22% tax bracket. And they think, okay, I'm making 150 for a few years, and then when I retire, we're going to turn on Social Security. I'm going to receive a pension, and then we're going to take some, 10 or 15 grand a year out for fun. Well, what's interesting, they say, we're not going to need 150. We need about, actually, I'll pull this down a little bit. We need about 120 to live our lifestyle of spendable money. We don't need the 150, blah, blah, blah. What's interesting is they don't realize that, and maybe you're seeing this already, they're already in the 22% bracket. right? So here they were in the 22% bracket when they were working, and here they are, they're actually actively planning, but they didn't put 2 and 2 together, that they're still going to be in the 22% bracket in the future. And one of the things we know, who knows if they'll go through with it, that 22% bracket is set to go back up to 25, right? So by itself, not only are they potentially going to be in the same bracket, but that bracket might actually increase in the future. And with Uncle Sam getting hungrier and hungrier, who knows what's going to happen beyond there. But even if they turned around and said, you know what, let me actually erase this. You know what, we can just live off our Social Security and our pension. And yeah, we're in the bottom of the 22, that's fine. We're just barely piercing it. That's okay. And life's going to go along here a little bit, and we're going to live frugally, and we have a little bit of cash, and we can travel. And, I'm kind of a little bit nervous about living a long time, so I don't want to touch my IRAs, and we're going to kind of keep our income down here and, maybe adjust it with inflation a little bit. Here's the deal. This is important. When they get to age 72 right now, that's when those required distributions start. Let me see, make sure this is coming up on the, yeah. This is when those required distributions start. They're also called RMDs. It's when Uncle Sam says you got to start taking money out of your pre-tax accounts to pay me my piece. Well, what if Social Security's here? What if their pension's here? And then what if that required distribution on $1 million account, it's going to be around just shy of 40 grand. So now that gets stacked on top of here, even if they don't want it. Actually, let me just try to do this. Yep. They got another 40 grand, gets stacked on top of there. Now they're piercing the 24 bracket, which in the future is set to go back up to 28. And there's nothing they can do about that. Meaning Uncle Sam is forcing this money out and they're pushing them in there, right? So the reason why I say this is that, and you've heard me talk about window, there may be a window, I'll use a different color. There may be a window in here where we can get money out in a tax bracket that we're aware of, maybe right in this space. We may be able to get money in a tax bracket we're aware of, and we'd be okay with paying the tax because we're going to pay it anyway in the future, if not more, to get money from red to blue, to get money from red to blue, to get money from red to blue, right? That rule of thumb is incredibly important. You have to do some math. It's worth doing some math and running some numbers to consider converting. That's taking chunks from the IRA to the Roth, because you may not be in a lower tax bracket in the future. And this was just an attempt to draw it out to show you the timeline. So if you have any questions about that, make sure you ask. But the last one is, or not the last one, the fourth rule is a rule that you've maybe heard me say before. I get it from a CPA that I follow and I learn a lot from. His name's Ed Slott. He says, never let a tax bracket go to waste, right? So what he means is he goes into looking at those brackets like we did just a moment ago. I'm going to go back to that picture. And he talks about if you know you're in X bracket, if you know you're in the 12 or you're in the 22, well, take advantage of that. Like, don't just be sitting down here, in mid 50s from an income perspective, saying, oh, we're okay. We don't have to, spend too much and we live frugally. Take advantage of this space if you can, because quite frankly, you may never see 12% ever again. Or you run the risk of that changing in the future. Even if, you just run the risk of that changing in the future. And if you're okay spending or paying 12%, if you're okay paying 22, like if your income's here, and you can take advantage of this space. Well, if you're okay paying 22, great. That's reasonable, knowing that you're avoiding, with any dollar you get to the blue, any dollar you get into Roth, you're avoiding a tax increase in the future. The caveat with that is we have to be very careful about Medicare surcharges once you're 63 or older. And that's for a different class, kind of getting into the Medicare surcharges, but because Uncle Sam looks 2 years prior to 65 when you start Medicare and stuff. The threshold, for example, actually I can pull it up, the threshold of adjusted gross, not just taxable, adjusted gross income for a married couple right now is 182. So if I add back the standard deduction, or if I can take the standard deduction into consideration there, it's probably just over 150. It's kind of the space where a couple who is approaching Medicare age, if they were willing and they understood these concepts, they got the idea of these rules of thumb for Roth IRA conversions. If their income was kind of down in this space, and they're like, we're in the 22 bracket, and we don't want to let a tax bracket go to waste, right? That was that rule of thumb. We could actually start considering converting 10, 20, 30, whatever it is, $1,000, and get us right up, snug up, right up to the Medicare surcharge line, right? I'll expand that conversation a little bit. Let's say we got somebody that has $2 million or $3 million in IRA accounts, and you're talking about Uncle Sam forcing you in the future to have to take anywhere from an RMD perspective, anywhere from, let's call it like just shy of 80 to 120 grand out in the form of an RMD. Well, that's going to push that person way up here anyway, right? So maybe they actually consider going up despite the Medicare surcharge a little bit. Maybe they actually consider filling up some of this bracket and taking advantage of it, and taking advantage of converting to Roth because of how valuable that would be for them in the future. It could conceivably reduce their RMDs and whatnot. There's a lot of math. Let me go back to that rule of thumb. There's a lot of math that goes into calculating this, particularly around tax brackets now and also potential tax brackets in the future. And hopefully you can see there's value to crunching those numbers. But the concept is take advantage of these conversions while you can to get money into that space where you can absolutely avoid Uncle Sam's increases in taxes in the future and spend every dollar that you withdraw from these Roth accounts. So I promised 5 rules of thumb. Let's take a look at what the 5th one is. And this is going to highlight a little bit about the required distributions. Also an area that I see confusion with folks. You can convert from IRA to Roth throughout your retirement, but you can't convert a required distribution. Let me read that again and I'll kind of talk through it. You can convert throughout your retirement, so you're not limited to just your 60s and early 70s. You don't have to, it's not a contribution. You don't have to have wages or earned income. So you can actually convert at any time. And there's no limit on how much. You just have to consider what the tax ramifications and Medicare ramifications are. You can convert at any time, even through retirement, but you can't convert a required distribution. So you have to look ahead, and you should look ahead. This is the rule of thumb. You should look ahead to see how you can give yourself options and flexibility when it comes time for RMDs. So let me go back to our timeline here. I'll get rid of a little bit of this, right? I'll get rid of a little bit of this. Let's go back over here to these RMDs, these required distributions. Right now, when you're age 72, whether you want to or not, Uncle Sam's going to force you. And when he sees that big bucket of IRAs and 401ks, right, he applies some math to that. And each and every year, he does a little calculation. Basically, your balance times a factor, percentage point, equals how much that you have to remove so that he can get his tax portion. That's a whole nother video that I envision myself kind of recording for everybody, is just kind of talking through required distributions, why they're there, why Uncle Sam's hungry, why he's requiring us to get the money out. He literally wants you to pull the money out, put it into this equation of the tax bracket, the marginal brackets, so that he can get his hands on this. And that's why when he forces you, say when you have $2 million in the accounts, $3 million in the accounts, whatever it is, when he forces you to take that out, you have to take it out, number one. You have to pay taxes on it, number two. But you cannot push that required distribution into your Roth. What he's basically doing, I'll take away our conversion here. What he's basically doing is he's forcing us to pull this money back out to circulation. So not only can he tax it now, he can tax it in the future, right? So this is an RM, so that I just got rid of the conversion over to blue. An RMD, a required distribution, is when he forces you based on that math, right? To take out X amount of dollars, pay tax on it, and then essentially plunk it into your bank account. I mean, technically you can plunk it in your bank account. You can reinvest it out here into a brokerage account. You can basically buy the same investments, right? But you have to rip it out of the tax deferred wrapper, and it has to be put into the taxable world, right? And that's the required distribution. So the reason why I'm talking about that is you could still do conversions in the future, but the challenge that we run into, depending on the person's situation, the challenge we run into is that, yes, we're trying to do conversions in here as well, which become taxable income, and we're pushing it over to the Roth bucket. But that actually, at age 72, that actually has to get stacked on top of a potential required distribution. Let me go RMD. RMD, required distribution, right? So it just becomes another piece of the tax equation and whether it's going to work. And quite frankly, again, we come back into that world where in this window through your 60s up to right now 72, we have a window where if you're proactive and you're picking up these 5 rules of thumb, you can really do some incredible work to keep more money in your pocket and to insulate yourself from tax increases in the future, and to really benefit yourself and your family if your family ends up becoming the heirs of some of these accounts. They benefit much more by receiving money that is tax-free to them. That gets right now a step up in basis. When I'm recording this, we still have that, as opposed to receiving money that is completely still taxable to Uncle Sam, right? So my parting thoughts on this, I certainly hope this was helpful and valuable. My parting thoughts are going beyond the nitty-gritty details of Roth accounts and qualified distributions and the 5-year rules and that stuff. These 5 concepts, these 5 rules of thumb should get you thinking about, is this on my balance sheet right now? Could I have more of it on my balance sheet? And how impactful would that be to me in my retirement? So that's actually why we created or distilled these 5 rules of thumb for Roth IRAs for you. So any questions, let me know, and I'll post this in our group, and we're just going to keep going. So that is our rules of thumb, 5 rules of thumb for Roth IRAs. Keep your eyes open for our future classes, and then once we turn the corner after Labor Day, we'll be getting into a lot more of the plain English, describing this stuff, describing the things that you're confused about in plain English, so you can make sure you keep the most money in your pocket through retirement.